Have you ever bought a stock that looked absolutely perfect on your screen, only to watch it collapse the very next day? It feels like the market is playing a personal joke on you, waiting for you to click buy before turning around. What if the problem isn't your luck, but the fact that you're looking at the market through a tiny, single window, completely blind to the larger forces moving behind the scenes? Most people lose money not because they are wrong about a stock's potential, but because they enter at the worst possible moment. Today, we are going to explore a legendary approach that promises to solve this exact problem. It's designed to help you see the market in 3 dimensions, filtering out the noise and showing you exactly when to strike and when to walk away. Welcome back to Backtested Hub. Today, we are diving deep into the triple screen trading system, a classic framework created by the renowned professional trader and psychiatrist, Alexander Elder. First introduced in his groundbreaking 1993 book, Trading for a Living, this system revolutionized how retail traders approach the market. Alexander Elder realized that most technical indicators give conflicting signals. Trend-following indicators tell you to buy when prices are rising, while oscillators tell you that the same market is overbought and you should sell. This contradiction often leads to analysis paralysis. To solve this, he developed a systematic process that uses multiple layers of analysis to reconcile these conflicting signals, helping traders make objective, structured decisions. To understand how this works, imagine you are looking at an ocean. If you only look at the individual waves crashing on the shore, you might think the tide is coming in when it's actually going out. In trading, looking at just one daily chart is like looking at a single wave. The core philosophy of this strategy is that you must analyze the market on 3 distinct levels, or screens, before making any trade. The first screen looks at the long-term tide, the second screen looks at the medium-term wave, and the third screen looks at the short-term ripple. By aligning these 3 perspectives, you ensure that you are never trading against the dominant market force. Let's break down the first screen, which is all about finding the long-term trend, or the tide. To do this, we look at a time frame that is 1 order of magnitude larger than our trading time frame. If you plan to trade on the daily chart, your first screen will be the weekly chart. On this weekly chart, we apply a trend-following indicator, most commonly the Moving Average Convergence Divergence, or MACD, histogram. We look at the slope of this indicator. If the weekly MACD slope is rising, it means the tide is bullish, and we are strictly forbidden from shorting. If the slope is falling, the tide is bearish, and we are strictly forbidden from buying. This single rule instantly eliminates the dangerous habit of fighting the major trend. Once we know the direction of the tide, we move to the second screen to find the wave. This is our medium-term view, which we analyze on the daily chart. Here, we look for a counter-trend move. If our first screen told us the weekly trend is up, we don't just buy blindly. We wait for a temporary pullback on the daily chart. To find this pullback, we use an oscillator, such as the 2-day force index or a classic stochastic indicator. We want to see this oscillator enter an oversold territory while the weekly trend is still strongly up. This represents a temporary dip in a healthy bull market, the perfect place to start looking for an entry. The third screen is where we execute the trade, finding the short-term ripple. It doesn't use a specific technical indicator. Instead, it uses a precise execution technique called a trailing buy stop. When the first screen is bullish and the second screen is oversold, we place a buy order 1 tick above the high of the previous day. If the market continues to drop, our order is not filled, and we protect our capital. We then lower our buy stop to 1 tick above the new previous day's high. We repeat this daily until the market finally turns around, breaks upward, and triggers our entry. This ensures we only enter the trade when momentum actually starts shifting back in our favor. Now that we understand the mechanics, let's put this classic system to the ultimate modern test. We are backtesting the triple screen trading system on one of the most volatile and heavily traded stocks in the world, Tesla. Our backtest spans a full decade, running from August 23, 2016, all the way to August 23, 2026, representing 10 years of market history. During this period, Tesla went through massive growth phases, extreme hype, deep drawdowns, and multiple stock splits. To keep our risk managed, we've added a modern twist to the original strategy, a trailing stop loss based on the average true range, or ATR, to protect our downside and lock in profits as the trend develops. Let's look at the raw performance metrics to see how this theoretical model translated into actual numbers. Over this 10-year testing period, the strategy executed a total of 100 trades. The win rate came in at 36%. Now, at first glance, a win rate in this range might seem modest to a beginner who expects to win on every single trade. However, in professional trend-following systems, you do not need a high win rate to make substantial gains. The key is asymmetry, keeping your losses extremely small when you are wrong, and letting your winners run when you are right. Through this disciplined mathematical edge, the strategy generated an impressive total return of plus 138.2%, which translates to a highly solid compound annual growth rate, or CAGR, of plus 9.1%. Now, let's compare these results to the ultimate benchmark, a simple buy and hold strategy. If you had just bought Tesla at the start of the backtest and held it through all the market's wild fluctuations, your return would have been plus 2,320.8%, with an annual growth rate of plus 37.6%. When we compare the two equity curves side by side, we can see a fascinating dynamic. While the buy and hold strategy experienced massive, stomach-churning swings that would have forced many retail investors to panic sell at the absolute bottom, our strategy's equity curve rose in a much more controlled, step-like fashion. It stayed in safe cash during prolonged market declines, preserving capital, and only participated when the multi-time frame alignment confirmed a high-probability uptrend. One of the most critical metrics for any serious trader is the maximum drawdown, which measures the largest peak-to-trough drop in your account value. It is the ultimate test of your psychological limits. During this decade, a buy-and-hold investor in Tesla had to endure devastating drops that would test the resolve of even the most seasoned market veterans. In contrast, our backtested strategy experienced a maximum drawdown of only minus 56.6%. By dramatically reducing the drawdown, this system makes it much easier for a trader to stay disciplined and stick to the plan without letting fear dictate their decisions. It proves that sometimes the best trades are the ones you never take, and staying in cash is a highly active and profitable position. However, no strategy is perfect, and we must talk about the limitations of this approach. The biggest enemy of this system is a sideways, choppy market. When Tesla consolidated without a clear trend, the weekly trend indicator kept flipping back and forth, while the daily oscillator triggered false entry signals. This resulted in a series of small, consecutive losses, often referred to as whipsaws or death by 1,000 cuts. Additionally, because the system requires multiple screens to align, it can sometimes miss the absolute bottom of a major market reversal, entering slightly late after the new trend has already been established. It is the price you pay for safety. Ultimately, the triple screen trading system is not a magic crystal ball, but a highly disciplined risk management tool. It forces you to trade with the wind at your back and buy only when the market is temporarily on sale. If you want to build a sustainable trading career, learning to manage multiple time frames is an essential skill. What stock or strategy should we backtest next? Let us know in the comments below. Don't forget to like this video, subscribe to Backtested Hub, and hit the notification bell so you never miss our data-back strategy reviews. Trade smart, stay disciplined, and we'll see you in the next video.